Hello and welcome to another wonderful lecture in labor economics presented to you in my beautiful Instructabunker. I'm very excited about what I'm going to be presenting to you today because we're starting on a new unit that I think is one of the many topics we've covered in this class that could easily be an entire semester's worth of material. And that is we're going to be thinking about human capital, which is an economist's way of talking about education. So to give a sense of where this unit fits in with the class overall, I just want to lay out a little bit what we've done and where we're going with this unit. So up until now, we've thought about a competitive model of the labor market, right, where workers and firms each take wages as given and make a decision about how much to work or how many workers to demand in order to set wages equal to workers' productivity and also equal to workers' value of time. Right, and in this model, how much a worker is paid is going to depend on how much the marginal worker produces, which in turn is going to depend on things like the availability of substitutes and the cost of substitutes, changes in firm technology, right? Things like trade changes or immigration changes or other things that affect the supply and demand of labor and of other factors that either make labor more productive or make labor less productive. Then we thought about a complicating model, right, complications to this story when firms have some power over the labor market. In other words, when instead of having to take a market wage as given, firms have some ability to adjust the wages that they pay their employees. And as we talked about, in that model, we're going to end up with wages falling below marginal revenue product, right? In other words, workers are going to earn less than they produce. And the size of that gap is going to depend on just how unproductive or how uncompetitive labor markets are. So instead of a model where essentially firms and workers are a team and workers earn more money when their productivity is higher, in a monopsony model, wages are determined as a sort of a power struggle between workers and firms, right? Where the more power, the more market power firms have, the less workers earn. And that's going to be a very important thing when we want to think about topics like inequality or wage stagnation. But at the same time, probably the single biggest determinant of wages and the single biggest factor when we want to guess somebody's wage is going to be measures of how productive a worker is. In particular, how educated they are, right? If we look at differences in earnings by education, we're going to see that workers with a college degree on average earn almost twice as much as workers with less than a college education. And as we talked about near the beginning of class, those differences are only growing over time and are even larger for workers with postgraduate education. So to the extent that education is capturing something about workers' productivity, this leads us to think that if we want to understand why inequality is growing, or we want to understand how to raise wages, or we want to understand how to increase economic growth, a really crucial part of this is understanding when workers invest in skills, how they invest in their skills, and how to increase those investments. And particularly so, since we're in this time period when technological change is pushing in a direction towards higher and higher returns to education, while worker education really has not caught up. So to think about this, what we're going to do in today's lecture is going to work through a couple of economic theories relating to the decision to acquire education or human capital. In our first section, we're going to talk about the optimal human capital decision of a worker, or of a human being, I should say, who doesn't face any credit constraints. That is, who's able to freely borrow from their future earnings or freely save money at some interest rate. Then we're going to think about the opposite extreme, workers who face total credit constraints, who are completely unable to borrow money or completely unable to save money. And then in our last section of today's lecture, we're going to move away from thinking about the optimal decisions of workers and instead think about the origins of the wage bonuses that come from increased education. We're going to think in particular about whether we should attribute those increases in earnings to increased productivity of workers, in other words, to learning, or whether we should attribute it to signaling. In other words, the ability to get an education, telling employers valuable information about their employees. Okay, so thank you again for joining me. I'm really looking forward to discussing this material with you in our in-person sessions, and I'm looking forward to virtually interacting with you until then in these videos.